If you spent any time online watching videos about inflation, money printing, interest rates, or government debt, you've probably noticed a certain kind of story keeps repeating. It usually starts with inflation, then it moves to money printing, um, then it connects rate cuts, government borrowing, asset prices, and inequality. And by the end, it feels like everything is kind of being hollowed out all at once. If that kind of video makes you uneasy, that reaction makes sense, okay? And it's not because the person is crazy, but because the mental model underneath it feels intuitive. Today I want to slow this down a little bit, okay? And I'm not here to argue politics. I'm not here to defend institutions. And I'm not here to tell you everything is fine. I want to talk about the core myth underneath most of these narratives, okay? Because once you see it, I think most of the conclusions that stem from them stop following, okay? Here's the myth. The myth is that the global financial system works like a pretty much single pool of money where printing, borrowing, and injecting liquidity are all basically the same thing. Um, Almost every claim in videos like this flow from those assumptions. But that assumption is wrong. Okay, and the reason the story feels convincing is because it used to be closer to reality. Okay, in simpler financial systems, expanding money supply did translate more directly into spending. But that is not how modern financial systems work. Today, money creation, liquidity provision, bank lending, and real economic spending are separate processes. They happen on different balance sheets, under different constraints. And so when you treat them as one thing, I think confusion is almost guaranteed. Okay, you'll often hear inflation explained as more money chasing fewer goods. And it sounds simple. And it is a logical statement, okay? Um, but it quietly assumes something that is no longer true. It assumes that when the central bank expands its balance sheet, money automatically enters the real economy. That assumption is false, okay? So when the Federal Reserve injects liquidity, it is not handing out cash to households. And it's also not funding spending. Okay, it is swapping one financial asset for another. And usually this is reserves for treasury securities. Okay, this transaction happens inside the financial system. Okay, between the Fed and the banking system. It it does not by itself create demand. Okay, reserves, they're they're not money that you and I spend. They are settlement balances between banks. Banks cannot lend reserves to households. Okay, they cannot spend them into the real economy or the economy. Um, Liquidity is not demand. Okay, another major misunderstanding is the idea that banks lend because they have reserves. Banks do not lend because they have liquidity. Banks lend when they see profitable opportunities. Okay, when borrowers are creditworthy, when capital allows it, and when funding is stable. Reserves are a byproduct of lending, not the cause of it. And this is why This is why large liquidity injections can coexist with weak lending and stagnant wages. You'll also hear that falling interest rates make borrowing cheaper for everyone. And that's not how rates work. There is no single one interest rate. There are policy rates, okay, funding rates, credit spreads, what else? Risk premia. Um, Rate cuts affect different balance sheets in very different ways. Okay, so highly rated borrowers with market access may see cheaper funding. Um, Households and small businesses often don't. And that's not, a conspiracy theory. It's just the plumbing, the structure of the system. Okay. Another common claim is that the Fed is printing money to fund government spending. That's incorrect. Okay. The Treasury funds itself by issuing bonds to the market. The Fed does not decide how much the government spends. So when the Fed buys treasuries, it is not financing spending. It is changing the composition of assets held by the private sector. Okay, the debt that already exists, that's important. Okay, the Fed is changing who holds it and in what form. Okay, short-term treasury purchases are often described as bailouts. And in reality, they are liquidity management operations. Okay, they exist to stabilize funding markets. Okay, maintain rate control, and really prevent plumbing failures. They do not inject spending power into the economy, the real economy, as people would say. They keep the system functioning. Okay, rising asset prices are often framed as proof of monetary debasement. And I think that's another mistake. Okay? Asset prices rise when discount rates fall. Risk premium compress, and funding becomes easier. Okay? None of that requires money to enter the real economy. Okay? So asset inflation is a financial phenom. Okay? Not a monetary one. The sample, the same applies to commodities. Okay, commodity prices are not driven by money printing. They are driven by supply constraints, inventory cycles, investment demand, and geopolitical risks too. Okay, as an example, rising copper prices do not mean the dollar is collapsing. They mean future supply is uncertain and capital is repositioning. Okay, these are market signals, not evidence of debasement. So, large government deficits also do not automatically cause inflation. Inflation depends on where spending occurs, how it is financed, and whether it expands capacity. Debt issuance without private credit expansion often leads to asset inflation, not consumer inflation, which is kind of what the real economy is worried about. Okay. Again, structure matters. Stories like this keep coming back because they really collapse complexity into a single cause. Okay. And that feels comforting because it makes sense, but it doesn't describe how the system actually works. Okay. The modern financial system is not one big bucket of money. It is a network of balance sheets, constraints, and incentives. So if you want to understand markets and inflation and risk, you really have to separate four things. Okay. You have to separate money, you have to separate liquidity, lending, and you have to separate spending. Now, make no mistake, they interact, but they are not the same thing. Prices move because funding conditions change. Okay? Risk appears when balance sheets are strained. Inflation happens when spending um, exceeds capacity, not when reserves increase. Okay? Investors experience all of this through prices, stocks, bonds, commodities. But prices don't move because money was printed. They move because financial conditions shifted. So when you confuse liquidity with spending, I think you misread markets. Okay, and this channel exists to explain the system beneath the noise and the narratives that are out there, okay? We're not here to deny risk or defend policy, of course, and not to tell you what to buy, but to give you a framework that actually matches reality. So, if videos like the one we discussed today make you uneasy, um, I think it's understandable to feel that way. But the danger isn't that the system is secretly collapsing. The danger is using the wrong map, okay? And markets don't move because of money printing. They move because balance sheets expand and contract. So once you see that, the noise fades, okay? So I'll see you on the next one. I'm Justin, and thanks for being here.